Hi there. Welcome to The Close. I'm Lindsay Biscaya. Markets will be closing in half an hour from now. So first, let's get to some of the stories we're following for you. Newmont Corporation wants Barrick Mining to improve operations before spinning off assets. According to Bloomberg, Newmont believes it has the power to potentially block the IPO. Barrick announced last week that it plans to spin off its North American gold assets into an IPO, which will include interests in the Dominican Republic, as well as its flagship Nevada joint venture with Newmont. Newmont has been ramping up pressure on Barrick after a string of operational setbacks. And shares of Air Canada are in the red today. The national airline says it is suspending service to Cuba due to an ongoing shortage of aviation fuel on the island. Air Canada says the decision was made after governments issued advisories about unreliable fuel supply, with fuel projected to be unavailable at Cuban airports starting tomorrow. The carrier plans to operate empty flights to bring back about 3,000 customers that are already in Cuba. And shares of Bombardier are edging higher after the jet maker signed an agreement to buy Velocity Maintenance Solutions. Bombardier says the acquisition will take place through its U.S. subsidiary and is aimed at expanding its maintenance, repair, and overhaul services in the States. Financial terms of that deal have not yet been disclosed. And shares of Novo Nordisk are moving higher today, while shares of Hims and Hers Health are tanking. Novo has sued the U.S. telehealth firm over patent infringement after it launched a cheaper copy of Novo's weight loss pill Wegovy. Novo is seeking damages for what it describes as reasonable royalties and lost profit. And taking a look at the markets, we'll start with the TSX up by 1.5% at the moment. Gold, silver going higher today, and that's edging up the TSX overall. If we take a look at U.S. markets, the tech sector continuing to bounce back today. You can see the S&P 500, the Dow Jones, and the NASDAQ all trading higher. And as we just saw, markets are up today with tech stocks leading gains across major North American indices. Our next guest is optimistic about equities this year and believes the earnings outlook remains positive, but is also seeing a lot of divergence. For more on this, we're going to bring in Kai Lam, Chief Investment Officer at JCIC Asset Management. It's good to have you. Thanks for joining us.
Thank you. Thanks for having me.
We are in the middle of earnings season. I'm wondering, first of all, what your impressions are, if there's any kind of key takeaways from certain sectors.
Yeah, I mean, I think the earnings season's been pretty good. We're constructive on the market this year, basically because it's been earnings driven. But we are seeing kind of a broadening out of earnings contributions from a lot of different sectors. And the market is getting a bit more discerning on where the earnings are coming from. But yeah, as you see the TSX, we're really getting a benefit from areas like gold and cyclicals in the base metals mining. That's been positive.
Apart from Amazon, all of the other major scalers exceeded their earnings estimates this quarter, yet their stock kind of went down after they reported earnings. A lot of that because of that aggressive spending that so many companies are talking about. How do you interpret this trend, for investors if they're looking at the Mag 7?
Yeah, I think because last year a lot of these companies did really well, and because they were the biggest driver for earnings. But at the same time, as their earnings growth started to kind of peak out, and then they also had increased spending on AI. The markets have been focusing on the other areas where the earnings have been improving. I think the market has been becoming more selective when it comes to how to play AI beneficiaries. And so then some of these have not performed as well recently.
Has that changed your view at all for any of the Mag 7 companies, like any of them at all, after you've seen what's been happening in the latest earnings report?
I mean, look, it really comes down to the earnings, and so we like companies like Google, but we're also getting the AI theme from other places. So, for example, we own TSMC, and this company we think is more insulated from some of these concerns because they're a beneficiary of AI spending. They make the majority of semiconductor chips in the world with over 65% market share. And while their customers include AMD, NVIDIA, Apple, Broadcom, it doesn't really matter where the demand comes from. They're probably going to manufacture it. in the meantime, competitors are at a disadvantage to them because the next two biggest players are Samsung and Intel. But operating margin for Taiwan Semi is over 50%, where Samsung is, we think is around low double digits, and Intel is actually losing money in foundry.
We've seen a lot of these companies adopting AI to improve productivity, even if that's increasing their margins in the short term. Have you seen this yet affecting the labor market, or when do you expect this to start seeing this affect the labor market?
One thing that we have seen is that the labor market has been kind of slow at the same time as earnings has been improving. And we think that trend will continue, where AI is going to help improve earnings and help productivity without seeing that as much upward pressure on the labor market. So that's part of the reason why we're optimistic about earnings, is because of this productivity improvement. But but from a labor market perspective, it'll kind of slow the pressure down on that side.
How would that affect the markets if you see that impacting the labor market?
I think the market is going to be more focused on the earnings. And so as long as the earnings and productivity improves, that's what the market will focus on.
Okay, let's look overseas now, because we saw the Japanese stock market rising today after the Prime Minister secured a majority vote. What do you make of what you saw in the markets overseas today in the Asian markets?
Yeah, so there was a snap election that completed yesterday, and the Prime Minister, Takaichi, she got a supermajority. And the market was very optimistic on that, because that means she'll be able to implement her different policies. One of the things that she wants to do is she wants to cut for 2 years the 8% sales tax on food to make life a little bit more affordable there. But she's also looking to invest in government spending for about 17 different priority sectors. And that includes areas like semiconductors, AI, nuclear, and she also wants to spend more on defense and security. So that's gotten that market a little bit more excited because of the increased spending that she wants to do.
Do you think investors, though, are underestimating the potential negative effects of that?
There is potential negatives because, for one, interest rate policy is not matching up with her view because they're increasing interest rates to try to keep inflation down, because inflation has been elevated. And so that would be interesting because they're a bit conflicted. And then there's also concerns about how do you fund that spending? And that could put pressure on raising bond yields and need to issue debt, in which Japanese debt's quite high. It's government debt is almost 250% of GDP. So that would be something that we have to factor in.
Okay, before we wrap up here, let's take a look at some of your stocks that you like. You like TSMC, which of course we talked about earlier. Also Dollarama. What appeals to you about these two?
So one of the things I like about Dollarama, one of the things that we've seen, when the market's been a little bit more concerned about AI spending and whether it's a bubble or not, you're seeing some rotation in defensive companies where you're not going to see that AI disruption. With Dollarama itself, it's a growth company that's all highly defensive, and they pretty much benefit from any economic environment. When the economy is slow, people trade down for looking for better value. They also can still grow 60, 70 stores every year in Canada. And then they have other growth drivers. They have 60.1% interest in Dollar City in Latin America. And a bit longer term, they're turning around operations in an acquired reject store in Australia. And then later this year, we're going to get a lot more probably volatility centering around U.S.-Canada trade relations. But this one is kind of insulated from that as well.
Okay, that's all the time we have. Kyle Lam, Chief Investment Officer at JCIC Asset Management. Appreciate your time. Thanks so much for joining us.
Thank you.
Up next, Newmont wants its partner Barrick to fix its Nevada operations before a planned IPO. We've got more on that after the break. The world's top gold miner Newmont has asked Barrick Mining to repair what it calls underperformance at their Nevada Gold Mines joint venture. Newmont says its Canadian partner must fix the falling output and rising costs at the venture before Barrick's planned IPO later this year. So for more on the issues behind the tussle and future outlook for Barrick, joining us now is Martin Pradier, materials analyst at Veritas Investment Research. Good to have you join us. Thanks so much.
Thank you.
So I'm wondering what you think of this and like the latest demand from Newmont. Could that actually affect the IPO?
Yeah, definitely could. Our understanding is that they have the right of first refusal, and that's why they are demanding things. There is no doubt that we were expecting better from Barrick. I was a little bit surprised when they came with the guidance, and the guidance shows increasing cost and lower production for Nevada than what they had previously communicated. You would think that, as Newman says, if you're going to do an IPO, you want first to fix the asset.
So for fixing the asset, like let's talk about that. What's behind the falling output, rising costs at the Nevada Gold Mines venture? Because that's what Newmont is kind of pointing to.
Well, this is not new. If you look at 5 years ago, it has been going down more like 20, 30%, the production. So there's a bunch of issues, obviously. What is interesting is that Barrick said we're going to review this, and they took 4 or 5 months to review, and we were expecting that they will come with plans of how they could increase the output. And the plans that they came out, that were communicated to the market a few days ago, actually show a decrease in the output.
Is that the guidance you're talking about in their latest Q4 results, their guidance for the Nevada operations?
Yes, the guidance in the latest Q4 result was, especially in Carlin, there was a significant decline in the production compared to what they have been telling us before, and even compared to the previous year. That was a little bit of a disappointment. And from the commentary from Newmont, I think it was a disappointment for them as well.
Mm-hmm. Newmont has previously shown interest in some of Barrick's, Nevada assets. Do you think after seeing this guidance from Barrick, do you think they're still keen to have those assets?
Well, I think Newmont is interested. I always thought that the play was that they will sell 15% in the IPO, and they're saying that they're going to keep 85%. And then once we have a market value, then Newmont could perhaps do a bid for getting 100%. I think that Newmont is interested only in these assets that are in the new company, not on the rest of the assets. So having a public market kind of value makes the transaction more likely and more possible in a way.
So do you think that this is all part of maybe a strategy by Newmont to get the best price for Newco?
I'm not sure, but I think that they would be interested in the new company for sure. I think that's there've been rumors before, and if they think they can do better than Barrick in terms of production and cost, then they might be able to justify it that way and saying, look, our plans is whatever, like, and we're going to increase production we're going to have lower cost, and this is part of the reason why we want to buy the rest. Because the way it works today is Barrick that is in charge of the production and the plans, and Newmont it's a minority partner.
So with all of that in mind, what do you think the outcome will be for this planned IPO?
I'm hoping it goes ahead, but I cannot guarantee anything. We'll have to see.
Yeah, I'm asking you to predict the future a little bit here. But I mean, when we're talking about Barrick Mining as a whole, like their stock has gained over the last year. What's your outlook for the stock and the company now that we're seeing what's happening here?
We are less bullish than we were before because the outlook that they presented to the market, it was a little bit of a shock. In terms of the cost, it was a very big increase in cost, 20% for gold, about 10% for copper compared to the previous year. And that's quite a bit of an increase. And then we have on top of that, these potential problems with the IPO. So we still have a buy on the stock, but we are a little bit less bullish than before.
Barrick has been kind of lagging behind some of its competitors in this recent run that we've been seeing gold going on. I'm wondering, do you know why that's the case? They have some, riskier regions in Pakistan or in Africa. Is that kind of holding them back, do you think?
Well, they had this big problem in Mali, right? So that was part of the reason. And the problem has been resolved, but at a high cost. I mean, Barrick has to pay a lot of money, and now the mine is not a low-cost producer anymore. It used to be one of the lowest cost-producing mine in their portfolio. Now it's going to be the most expensive, about $3,000 per ounce in the coming year, according to their estimates. So yes, there has been a big cost on that. Mm-hmm. And the other surprise was that they're now talking that they're reviewing Reko Diq, and it looks like it might not go ahead after how many years in the planning. So they're not so convinced that the risk is worth going there, because the mine is great. Okay. But the region is quite volatile, and I think a lot of people knew about it.
Okay, we will leave it there. Martin Pradier, materials analyst at Veritas Investment Research. Appreciate your insight. Thanks so much.
Thank you.
Last night's Super Bowl 60 saw the Seattle Seahawks clinch the title over the New England Patriots. We will dive into the business of the game right after this. Last night's Super Bowl 60 saw the Seattle Seahawks clinch the title over the New England Patriots. And for more on the business of the big game, we were joined by Bloomberg's U.S. sports business reporter, Randall Williams.
You look at the previous Super Bowls, we had Patrick Mahomes, we had Jalen Hurts, we had Travis Kelce, we had Christian McCaffrey, and so many other big names. And Sam Darnold is a journeyman quarterback, and obviously it ended at the podium yesterday. On the other side, you have Drake May, who didn't play well all postseason, is not the biggest name in the world, though he was an MVP candidate. It didn't work out for Drake May, of course, and I think from that aspect, stardom does matter in terms of bringing in viewers. But I think the NFL is going to be just fine.
And you say they're smart, the NFL. They keep the product scarce. That's one of the ways they get big ratings.
Yeah, the NFL season has about 272 games, not including the postseason. And so every single Sunday, fans go from a lot of people go to church and then they get back in time to watch these games. And when you think about the NBA and the MLB, there are so many games being played all across our networks. And that's fine. It's great that they have access. But the repetition of having Sundays at 1 p.m., 4 p.m., 8 p.m., and then a Monday game and a Thursday game has sort of become routine for audiences that are tuning in.
And you note, you have an amazing figure here. Last year, 83 of the top U.S. broadcasts were, in fact, NFL games. So there's just a segment of the population that are just diehard football fans.
Yeah, football is religion here in America, whether that be college sports or the NFL. These games really, really matter to people because if you lose week 1, if you lose week 2, if you lose week 17, that can cost you the playoffs. And, the NBA and the MLB have similar things, but the margin for error is so much larger. And on top of that, their playoffs are 7-game series. So in the NFL, you get one shot. And that one shot, everybody wants to know and see how the game's going to turn out and who's going to rise to the occasion.
Is there any risk that the Super Bowl will eventually peak in terms of cultural relevance, the younger generation not tuning in, for example?
I don't see a peak right now. I do think that the halftime show is going to have to continue to evolve. The athletes are going to have to continue to evolve. But I think that, look, the world has been going on for a very long time, and it's produced superstars in every era. And so there will continue to be superstars in football and on the music scene as well. And I think the advertisers will continue to evolve. And so with that in mind, I think the NFL's challenge is going to be taking it to the next level and continuing to draw in viewers at a record pace. But right now, when you do 127 million viewers based on last season's game, and that game was a blowout, you know, it's one of those things where it's like, how high can they really take it?
Why do cities want to host it? Is it the influx of tourist dollars, for example?
It's definitely tourism dollars, but also, you know, you think about the economic impact on San Francisco. They're estimating over $500 million. If you think about New Orleans said between the city of New Orleans and the state of Louisiana that the Super Bowl had $1.25 billion of economic impact on the region. And so for these billionaire owners, that's more money for them. If you want to have, you know, more cash in your pockets, you're going to raise your hand for the Super Bowl. Now, outside of having a stadium, outside of having, you know, the hotels, it does matter from a logistical standpoint. How can people enjoy this? Are fans going to have a good time? Those things matter, and the NFL is identifying cities, stadiums, and hotels and regions that can do this and put on the best show possible.
Now, you note that until 1993, there would just be things like college marching bands at halftime. But then, of course, Michael Jackson came on, and that really transformed halftime. And it always blows my mind that the artists pay all the costs of appearing.
Yeah, they do. I mean, the actual logistics of who's being paid and all of that has never come out, you know, officially. The NFL and Rock Nation haven't revealed that. But there is a huge impact from these artists, their streaming numbers. I'm sure Bad Bunny, who performed yesterday, is going to have probably a 100% at minimum increase in streams across the world. Rihanna saw 640%. Usher saw 550% increases on Spotify. And so this halftime show has a huge, huge impact. And Bad Bunny is a huge artist. He's one of the most streamed artists on the planet. And he put on a great show yesterday. So he's going to see that same impact as well.
Yeah, I tuned in, and I'm not the biggest fan of him, but I thought that show was amazing. The technical achievement, the athleticism, the constantly moving viewpoints.
It was great. It was great. It was great to be in the stadium and experience it. I think the messaging was great. I think that, look, Bad Bunny there's been a lot of speculation as to how this show would go. Would it be super political? And I think that symbolism is something that you should always look for in a halftime show, as opposed to someone saying something on a mic. Why is that? The reason for that is because, you know, the NFL has relationships with both its broadcasters and with the Oval Office. And the last thing that they want to do, regardless of the party that is in office, is to put a target on their back. So symbolism is a big theme, not only in this year, but in previous years as well. And Bad Bunny executed on that.
That was Randall Williams, Bloomberg's U.S. sports business reporter. Well, up next, the closing bells on Bay Street and Wall Street. Stay with us. We'll be right back. Here are the closing bells at the NASDAQ. Zillow Group is ringing the closing bell tonight. At the New York Stock Exchange, Flowtech Industries is ringing the closing bell. And on the TSX, RFA Financial is celebrating the company's new listing on the TSX. You're watching The Close on BNN Bloomberg. I'm Lindsay Biscaya. Here's how we close the day on Bay and Wall Street. And here's a look at the U.S. markets. The TSX finished the day up 1.7%. The S&P 500 up by 0.4%. The NASDAQ Composite up by 0.9%. Something else we were watching for today is the Dow Jones. Did it beat a new record? Yes, it did. So it hit a fresh high of 50,000 on Friday. It closed above 50,000, and now we can see it's closing above what it was on Friday, which was 50,115. So a fresh record high on the Dow Jones, and we'll, of course, watch that for you. If we take a look at some of the big movers of the day, Orla Mining is up about 8% as gold prices rebound, seeing many mining stocks bring the TSX up today. It finished the day up more than 10%. If we continue to follow some of those material stocks, Nova Gold also up because of gold prices, but also climbing on the news of progress in the Donlin Gold project in Alaska. Nova Gold owns 60% of Donlin Gold, so that shot the price up almost 8% to finish the day. And another big mover on the TSX moving potentially in the wrong direction for a lot of people is Air Canada. That's one of the biggest laggers, finished the day down almost 5%. The airline says it's suspending flights to Cuba because of the fuel shortage situation in that country due to the U.S. cutting off oil supplies for Cuba for some time now. And there's no word at this point on when flights could resume. So that hurt the share price today for Air Canada. South of the border, NVIDIA shares have jumped up. They were up almost 3% to end the day, up 8% at one point during the day as the market rebounded in the tech sector. We're seeing that, of course, throughout the day. Nexstar Media Group seeing its most significant gain in 11 months, up almost 9% to end the day. Trading volume surging there. And we're also watching shares of Oracle. It was up more than 9% to finish the day after receiving an upgrade to buy from neutral at D.A. Davidson due to optimism around OpenAI and its beneficiaries. And we're actually going to chat with that analyst at 4:50 p.m. Eastern Time today. So for more, we are now joined by Bloomberg's equities reporter Stephanie Hughes to break down some of the big movers today. Stephanie, as we were just talking about gold prices soaring, and we're seeing that, IM Gold Corporation shares jumped more than 9% at one point today. What's driving that?
Hey, Lindsay. Yeah, good to see you. So that's because the shine is really returning to precious metals. So IM Gold shares have gained by over 10% actually at its highest point today, which marked its biggest intraday advance since November. And it's gaining on the back of rising gold prices, which have returned to their to above the 5,000 an ounce mark as dip buyers are returning to the market after a very volatile week for precious metals. So the question for some market strategists is whether this is just a reactive bounce or if it could move into a really sustained gain for precious metals. And so obviously, despite that setback we've seen in recent weeks, gold has still really been on a tear over the past year, just this roaring ascent, primarily driven by geopolitical uncertainties that are causing this flock to safe haven assets. And then, of course, the Federal Reserve cutting interest rates, which benefits an asset like gold, which doesn't pay interest. So alongside IM Gold, which had been the top performer on the TSX earlier today, we are also seeing Orla Mining, which you mentioned as another TSX-listed metals miner that's gaining, First Majestic Silver and others, Lindsay.
Yeah, a lot were gaining, but on the flip side, though, Vizsla Silver Corporation, that stock price was at its lowest level in about 4 months today. So what happened there?
Yeah, it's a much different metals mining story and a very unfortunate one at that. Vizsla Mining, or Vizsla Silver, I should say, those shares fell by nearly 16% at its lowest point. That brought the stock price to its lowest level since September. It was also by far the worst performer on the TSX today, and that's because the metals miner said that some of the people that were kidnapped from its Panuco project last month have been found deceased, according to the company said, using statements from some family members. And the company is awaiting confirmation from said it was awaiting confirmation from Mexican authorities. And CEO Michael Connor said that the focus is on the safe recovery of some of the individuals who are still missing during this difficult time. So to catch viewers up to speed, in January, the company said that 10 people were taken from one of the mines in Mexico in a security incident that affected the company and obviously the individuals who work there. And since then, since the company reported this last month, the shares have fallen over 30%, still well into the green on a one-year basis, but obviously the stock price and company is feeling the effects of this incident, Lindsay.
Yeah, share price down almost 13% to end the day. Okay, that's Bloomberg's Stephanie Hughes reporting live for us. Stephanie, thanks so much for that. Up next, U.S. markets rose today as investors regained optimism about stocks in the tech sector. We'll be back in a moment with more on that. Welcome back. U.S. markets rose today, led by technology stocks. And this follows last week's sell-off of AI-related companies due to concerns about their CapEx plans. So our next guest remains cautious on hyperscalers and sees greater potential in semiconductor stocks instead. Let's get more now from Oh-Shung Kwan, Chief Equity Strategist at Wells Fargo. It's good to have you join us. Thanks so much.
Thanks for having me.
So we've seen this kind of rapid shift in market sentiment when it comes to those hyperscalers. What are some of the factors behind that shift, do you think?
Yeah, I think it's really the CapEx, the size of CapEx that they have to invest in, because I think this is really on arms race that they kind of have to invest to not get disrupted. Every single quarter since 2024, there was a step-up increase in hyperscalers' consensus CapEx numbers, and we saw the same thing so far this year, compared to where CapEx numbers were for 2026 at the beginning of the year. It rose by about $120 billion. So I think that's going to be the trend going forward as well. And their return on incremental invested capital is going to be similar to the S&P 500. All the free cash flow metrics are actually going to be below that of the rest of the index. So yet they're still trading at a premium versus the rest of the index. So I think there's still more downside and cautiousness around hyperscalers overall.
And we've seen Bloomberg reporting today that Alphabet's bond sale drew over $100 billion worth of demand. Like, I'm wondering what that tells you when you see a company as big as Google still kind of feeling the need to tap that debt market.
Yeah, I mean, for those guys, it's actually a lot cheaper to debt finance than equity finance. And I think that trend is likely to continue. Back in Q4, we saw the big four companies raising $100 billion in debt. And I think that's going to be the case going forward in 2026 as well. They're going to continue to issue debt because it's cheaper, and they're going to continue to invest in CapEx for AI. If you look at how much CapEx has been funded with that so far, it's been only about 2-3% that's been funded with that, whereas the prior investment cycles during shale and during telecom, the number was 15% and 30% respectively. So, we are still in the early innings of this leverage-led CapEx cycle.
Okay, so you're obviously cautious on the outlook of the Mag 7. We touched on this off the top, but are there sectors that you think could still be lucrative for investors who want to still be in that AI kind of trading game?
Yeah, I mean, within the AI complex, we still like semis. CapEx is going higher, and you want to own the picks and shovels that are going to benefit from ever-increasing AI CapEx. The other non-AI sector, we are bullish as well. We are starting to see some green shoots in non-AI, whether it be energy, materials, some of the commodity sectors, as well as short-cycle industrials that have really been sluggish for the past 3 years. We think we are finally in this reflation cycle for the first time in 3 years. And I think it's going to continue. The PMI data that we saw earlier this month, I think that was essentially the beginning of the PMI upcycle going forward. Post the tax return season, when people are going to get a lot more money this year versus the last year, that's going to translate into higher demand for goods. Also, inventory levels are pretty depleted. And back in January, we saw the sharpest inventory rebound in 3 years. So we're finally in this restocking cycle after 3 years of destocking. And those things really point to continuation of this PMI upcycle.
When we're talking about the software sector, I mean, we saw some interesting things happening in recent weeks when Anthropic released their AI tool, and there was that sharp sell-off. A lot of analysts saying that was kind of overdone for the software sector. But I'm wondering, like, in the long run, do you think what we're seeing with AI is going to render software stocks and companies kind of obsolete?
Yeah, I mean, I think there are going to be software companies that are going to be disrupted by AI. I mean, this is kind of a natural cadence. When new technology comes out, there are going to be companies that get disrupted. What the market was doing over the past week or two was that it shot first and is going to ask questions later. It basically sold all software stocks as a group, and basically said that all software stocks are going to be disrupted by AI, which I don't think is the case. There are going to be companies that actually benefit from AI as well. Those, infrastructure software or those that are more consumption-based model softwares. I think those companies, it might be a great buying opportunity. Also, based on our newly launched systematic sector strategy, software actually ranks number one. Because their sentiment is at the rock bottom and their earnings cycle is still pretty healthy. Back in Q4, software companies actually posted 25% EPS growth year over year. It was the strongest EPS growth in 2.5 years, and they beat consensus by 5%. So the earnings cycle itself, fundamentals are still very strong. It wasn't really anything to do with fundamentals today. It was expectation that those fundamentals are going to get disrupted, which I don't think will be the case across the board. There are going to be winners within software as well.
Interesting. I guess we'll have to wait and see who those winners are. In terms of the markets, like going back to the markets as a whole, something else that's been kind of moving them one way or another this year so far is when Donald Trump announced his pick for the next Fed chair, Kevin Warsh. I'm wondering what your opinion on Warsh is in terms of how he could change how the markets are moving.
Yeah, I mean, I think the market got a little too bearish on the announcement on Friday, 2 weeks ago, I think. Oh, yeah, a couple of weeks ago.
It's hard to tell at this point.
Yeah, I know it's been too busy, but you know, his hawkish view on the balance sheet was really the thing that the market was concerned about. The issue with that theory is that yes, he might be bearish on the balance sheet, but the Fed is still going to be purchasing $40 billion for the next few months, and even after he joins in May, I think it's going to be hard for him to immediately start to shrink its balance sheet because liquidity is still very tight. And I mean, that's what the market is telling us. The liquidity was really tight back in Q4 last year. And that's why the Fed decided to inject balance sheet or inject liquidity. And with that, we started seeing liquidity improving in the first half of January. And then in the second half of January, we started seeing liquidity draining again because of the tax seasonality. Looking ahead, our view is that our liquidity indicator, which has been a leading indicator of the S&P's multiples, that's likely to trigger a buy signal by the end of May. And what that means is, historically, when the buy signal triggered, the S&P 500 rose 100% of the time over the next 6 months, rising by about 13% on average. So there will be a very, very strong buy signal that we're going to get, regardless of what Warsh ends up doing when he becomes the Fed chair. We are probably going to see that liquidity upcycle over the next few months, and I think that'll be very bullish for the market.
Interesting. Okay, we'll leave it there. Oh-Shun Kwon, Chief Equity Strategist at Wells Fargo. Appreciate your time. Thanks so much. Coming up, we've got fourth quarter results from pure play royalty company Prairie Sky Royalty, and we will dive into those results right after this. And we have fourth quarter earnings results from Prairie Sky Royalty after the bells. And you can see average royalty production missed estimates. It increased by about 3.9% year over year. When it comes to revenue, also missed estimates, down 18% year over year. And earnings per share also missed estimates. The company does say, though, that it's increasing its annual dividend to $1.06 per share. And of course, we don't have an after hours graph. So what you're seeing right now, that's where it closed for the day. Let's bring in Jeremy McCrae, Managing Director and Energy Research at BMO Capital Markets, to kind of break down what we're seeing here. It's good to have you join us. Thanks so much. I'm wondering what your takeaways are here from what we're seeing in this earnings report.
Yeah, so some of the first numbers that you mentioned there in terms of revenue, EPS, a lot of this is based on the decline that we've seen in oil prices over the year over year. And I think when you look at what we were expecting for numbers versus what they came in, it was right in line. And I think this is the big thing that investors are going to look at here tomorrow. Prairie Sky is one of those names where you can just solidly rely on pretty steady growth quarter after quarter, year after year. And basically, when we look at what we're concerned about, and specifically oil production growth, we saw a 6% increase year over year. And with the reserves, that also matched at 6%. So it just shows you that you're seeing the growth in production and reserves up those 6%, which is important when you have a declining oil price environment.
Is that why the company decided to increase its dividend? Because that's obviously usually a sign of confidence in a company.
I think that's exactly it. If they were concerned, you wouldn't see that increase. I think the other thing, too, that we're balancing is the number of buybacks that the company is also doing. So in show of strength, you can see that dividend has been raised, every year since COVID. And also we're continuing to see more buybacks as the year progresses here as well.
Does anything you're seeing here in this latest earnings report change your opinion of Prairie Sky?
It doesn't. And I think it just reinforces the fact that this is a name that investors can rely on for that steady growth here. And basically, it's a bit of a proxy on what you see for the basin. So despite that, we saw oil prices have a pretty good collapse over the last couple of years. Prairie Sky has still seen royalty and third-party activity on its land continue to grow. So we've seen pretty much rigs drop in almost every major basin here in North America, but where we're still seeing growth on Prairie Sky's land in the Clearwater and Manville, those are the two areas that we're still seeing rig activity increase year over year. So for any investors who are looking for a proxy on how to play the Manville and the multilateral technology, Prairie Sky is showing once again with this quarter that this is a name that you can get that steady growth.
And Prairie Sky stock did hit a new high recently. What does that tell you about the company?
It just shows that investors are starting to pay attention. And when you look at where is their growth in this kind of commodity price environment, it's hard to find names that are showing as much profitability as we once did. And that's where royalty names still have that high margin. So you don't nearly see the revisions to cash flow under low commodity price environments. But at the same time, too, it's good to see that they're still seeing growth because the assets that underline these royalties are still seeing levels of, high levels of activity. And that's what we're always looking for in these reports is, are you still seeing new licenses? Is the company still seeing new rig activity? And the initial look shows that we are seeing that continue.
You touched on this, but with oil prices up around $60 to $65 a barrel, I'm wondering how Prairie Sky compares to other companies maybe in the market with these prices.
Prairie Sky won't have the torque like a lot of other names. As a royalty company, you just don't get that. But it's that name that we find a lot of investors just like to tuck away in their portfolio and can rely on the steady dividend, buybacks, and you're not going to get surprised by this name. So it doesn't have the torque that some other names do, but it's more for those investors who are looking for that steady, I guess you could say blue chip oil and gas company in their portfolio.
How are you feeling about the sector as a whole? We've been seeing so many things happening, right? Like crypto sell-off, rising precious metal prices. How are you feeling about the whole sector?
It's a good question. It's probably the number one question we get is how does this compare to the run-up that we've seen in other commodities and other sectors here? We've seen, the sector start to see some new interest, especially when commodity prices look like they're at cycle lows. And when you have the noise of oversupply, you're just not seeing commodity prices move lower on that. And I think it just really shows that, maybe oil demand is higher than we thought. OPEC is still keeping a firm eye on making sure they're not oversupply. And as a result, we're seeing the market start to price in higher oil prices, even though we haven't quite seen those higher oil prices here yet today. So it does show that the market is getting a little bit comfortable that we may have seen a bottom in the commodity. And it's one of the only sectors that hasn't moved up nearly as much as some of these other sectors that we've seen.
Okay, we will leave it there. That's Jeremy McCrae, Managing Director of Energy Research at BMO Capital Markets. Appreciate your time today. Thanks so much.
Thank you.
A new Angus Reid poll on Alberta separation shows that despite much noise by Alberta separatists wanting to leave Canada, the vast majority of Albertans want to stay. We'll go to CTV's Judy Trin for more.
Coverage of the Alberta separatist movement lately shows long lineups of people queuing to put their signatures on a petition calling for a referendum. There has also been reports of the leaders of the separation movement traveling down to Washington, D.C. and meeting with Trump officials to discuss the idea of separation. But according to a new Angus Reid survey, the support for separation is actually wishy-washy. According to the Angus Reid survey, fewer than 3 in 10 Albertans say they would vote for their province to leave Canada. That's 29% of Albertans. Of that number, only 8% say they are definitely leaning that way, so it's not bedrock support. But the numbers of Albertans overwhelmingly in support of staying within Canada, 57% say their support is definite. Now, there are other takeaways from this Angus Reid poll. A majority of Albertans, 54% of them, disapprove of how Premier Danielle Smith has handled the issue. Danielle Smith has said that she supports a sovereign Alberta in a united Canada. Now, also, the survey shows that 3/4 of stay voters say they would leave Alberta and move elsewhere if Alberta votes to separate. Fewer than a quarter, 23% of them say they would stay in a newly independent Alberta. What the survey shows is that although there is momentum from the separatist group in terms of mobilizing support, for the overwhelming majority of Albertans, they believe in a united Canada and want to stay. However, this is just a snapshot in time, and those numbers could move. Judy Trin, CTV News, Ottawa.
Up next, find out why NVIDIA is best positioned to benefit most as major technology companies continue to increase their capex on AI. We'll be back shortly with more. Eli Lilly is buying biotech company Orna Therapeutics. The deal is worth about $2.4 billion US in cash and is aimed at expanding Eli's pipeline beyond its popular obesity lineup. Orna is currently developing a new class of treatments for certain autoimmune diseases, and its technology allows patients' cells to generate therapies inside the body. Clothing retailer Eddie Bauer has filed for bankruptcy with plans to sell as many of its stores across Canada and the U.S. as possible and liquidate the rest. The brick-and-mortar chain listed more than $1 billion in debt. The move marks the third time the company has filed for bankruptcy. Eddie Bauer's e-commerce and wholesale operations, as well as its retail stores outside of North America, will not be impacted by the wind down. And shares of Cleveland-Cliffs plunged today after the steel manufacturer reported lower fourth-quarter revenue as well as profit that missed estimates. Cleveland-Cliffs says 2025 was weighed down by weak production from the auto industry as well as a weak Canadian market. The steel company says things are improving for 2026 so far. And Apollo Global drew in nearly $30 billion US of positive cash flow during the final 3 months of last year, pushing its assets under management to a new high. The firm also beat on profit and revenue, with revenue surging 87% compared to the year before. Apollo also had a record quarter for deployment of capital. And with AI capex increasing more rapidly than anticipated, our next guest believes this trend will benefit the picks and shovels segment of the AI market. Let's bring in BNN's regular Ivana Delevska, founder and chief investment officer at Spear Invest. It's good to have you. Thanks so much.
Thanks for having me, Lindsay.
So I'm wondering, just to start off, do you think that the concerns regarding the capital expenditure results were overblown? We heard of a lot of big companies saying they're going to be, aggressively spending.
Well, I think the concerns around returns. We are seeing capex continue to expand at a much faster rate than we previously anticipated. So the question is going to come whether companies and consumers are seeing really the benefits of this spending. We think they are. The question is going to be, where do these returns actually accumulate? Is it on the consumer side? Is it on the company side? But we think the returns are there. And the more important point is the capex is getting spent no matter what. So we are seeing about $200 billion more capex spent than what we originally anticipated, which is basically going to flow directly through the picks and shovels.
And I want to get to the picks and shovels, but first, maybe it depends on what company we're talking about too, right? Like if you look at Google, for example, given their strong cloud business growth, do you think the increase in spending is justified?
So if you look at the mega caps overall, I think the increase is justified for each and every one of them. And the reason is because if you don't spend, you're going to fall behind. So if you actually look at the mega caps, the more the companies spend, the better their position. So Google was among the ones that increased capex the most, and we think they are one of the best positions. Similarly, on the other hand, Microsoft has been actually lagging a little bit in CapEx spending, and their business is coming under attack. So I think that really the way to look at long-term differentiation is going to be who has the long-term moat, which is really going to be created by who is spending the most.
What was interesting was Meta's stock rose after that company reported that it was going to be spending more. What do you think Meta is doing differently from some of these other bigger companies?
Well, the expectations for Meta were really low, right? So they really surprised to the downside last quarter, and it was really mostly expectations related. I think it's still a show me story. They do need to show equally as much as the other, as the hyperscalers do in terms of getting the returns on investment on this CapEx spend. But I think the expectations were much lower for Meta than for Amazon, Google, and Microsoft.
What about NVIDIA when we're talking about higher spending? Also factoring the potential for a memory chip shortage in that sector. Like, does that affect your investment, do you think, or your opinion of NVIDIA?
Well, I think that companies that were seeing this boom coming were able to secure the supply of memory and other components to be able to meet demand. So we're not so concerned, especially in the near 1 to 2 year time frame in terms of component supply. I think basically the way to think about it is out of this earnings season, we got $200 billion more that are going to flow to NVIDIA and the rest of the value chain. So really, NVIDIA is going to capture the biggest dollar amount of that. But for some of the smaller players, in terms of percentages, they're going to be able to double or triple their revenue in a 2 to 3 year time frame. So really, I think the key is to look down the value chain.
Okay, so 2 to 3 years for some of those companies, because that was going to be my next question, right? Is like, how long do investors have to wait to see the results of some of this spending, and how long do companies have before people kind of lose their patience?
Well, the key is what exactly do you do, right? So if you sell picks and shovels, as in optical components, networking components, or any like memory, for example, you're seeing the benefits today. So you really don't need to be waiting, and you're really at the question there is more like, are you closer to the peak of the cycle or are you in the early innings? So I think this is where we're seeing the real-time returns. Now, a new area for us has been semi-cap equipment. These are companies that benefit from the companies spending on CapEx, so adding incremental capacity. So as we get further, you're going to need more memory capacity, more logic capacity. This cycle just began last year. So it's something new and something for investors to put on their radar.
So with that in mind, what companies do you think investors should be looking at with the picks and shovels aspect of this?
So on the picks and shovel side, optical components like Coherent, they're benefiting real time, to my prior point. On the semi-cap equipment, we really like Lam Research and KLA. Those are two companies that are going to benefit from the CapEx equipment cycle kicking in. So those are the two kind of main areas. We disclose all of our holdings on our website, but I would say within picks and shovels, one component is benefiting real time, one component, the cycle is just inflecting. So you really want to get exposure to both of those components to get the best risk reward.
Okay, so two good picks there. If investors are kind of looking to make their own picks in terms of the picks and shovels area, what should they be looking at in companies to make their pick?
Well, I think the key is going to be to figure out where is your investment falling in the cycle, right? Is it an early cycle play on the chip design side, for example? We're already in year 3 of that, right? If it's a later cycle play on the semi-cap equipment, we're really in the early innings of that. So I think it's becoming increasingly important for people to understand the different sub-themes that are within AI. If you looked at this sector 2 years ago, everything was going up, right? Mega caps were going up, smaller caps were going up. Everything was getting lifted by, like the tide rose all boats. Now we're seeing something very different, which is people are scrutinizing every company, and really the better investments are going to be the ones that are actually delivering the earnings growth and the returns on invested capital versus the ones that are just spending, but you need to wait longer to see the returns.
Mm-hmm. Okay, we will leave it there. We're out of time. Ivana Delaveska, founder and chief investment officer at Spear Invest. So good to have you join us. Thanks so much.
Thank you.
Up next, we will take a look at gold as it rose above 5,000 yet again. Stay with us. That's next. Gold advanced just over $5,000 today, and we were joined by Rebecca Telcher, portfolio manager at New Haven Asset Management, for some perspective.
What we saw in, commodity prices, whether it was gold, silver, the markets, we saw a lot of volatility, particularly in the metals, and that translated to the TSX. And now, we're seeing a little bit of a reversal of that as gold, goes back above $5,000 after, dipping below that last week.
Mm-hmm.
At the end of the day, gold is, a neutral asset. And what we're seeing is as investors are taking money away from risky assets, whether that's going to be the tech sector, which we saw last week, whether that's going to be Bitcoin, that's down 20% just year to date. And whether that's going to be away from the US dollar or treasuries, they are searching for a safe haven. And right now, gold is one of the only areas that's providing that right now.
Of course, gold became highly volatile itself, though. I guess there's no safe haven in investing, ultimately. Maybe government bonds come close.
Well, the thing is, government bonds used to be a safe haven, but, as we're seeing all these government shutdowns, as we're seeing, debt levels climb to record highs with U.S. deficits, not coming down. I think we saw that at least last year, the spread between corporate bonds, narrowed, not because corporate bonds were trading at, a discount, meaning that the economy is okay, but it was the opposite. We saw, a premium for the yield, like the yields of government bonds going up because investors were worried that the U.S. won't be able to pay back their debt. So as you say, there is no risk-free asset anymore. And with interest rates coming down, I think that's, creating more of an opportunity for places like gold.
Those tech stocks, I'm just looking at the list of big stocks in America hitting 52-week lows this morning. Adobe did. Its lowest in at least a year. Salesforce and ServiceNow. So those three names, classic software names, all under pressure again, certainly in early trading.
Yeah, software has its own issue with the idea that, AI can take over some of their business. But even with the large hyperscalers, like what we've seen with the Magnificent Seven, those stocks really outperformed in the past, for the past 2 years. Since the introduction of ChatGPT. And, it's a new technology. I get it. It was really exciting. I do think AI is here to stay. I'm not questioning that. But now the question is, okay, we've seen now several years of what AI can do, but how is that going to translate into revenue? And so, what we saw last week with earnings is, Amazon is spending $200 billion in CapEx, in 2026. Google's spending 175, Meta's spending 115 billions of dollars. These companies that were asset light are now becoming very asset heavy. And, we don't invest in that sector because it's a little bit too risky for us. Valuations are too high. There's no dividend yield, to support the stock price. But if I was an investor in those stocks, I would absolutely be concerned at how much money is going into the sector without any indication of how this is going to translate into revenues or income growth.
Yeah, it's interesting. You're calling it a race to the bottom. It's kind of a mirror image of a race to the top, isn't it? They are spending more and more. And I am curious. $200 billion by Amazon. So they're obviously thinking, well, we'll earn $200 billion in profits here. But from what? Who's going to pay them $200 billion in earnings? Consumers are going to pay.
And that's why we're seeing Amazon stock really under pressure. I don't think investors are necessarily buying it. Google's a little bit odd because they're, spending almost as much as Amazon, but they seem to be getting like a free pass with the market. Like they haven't seen the same share price weakness that Amazon has, and perhaps they're showing more of a translation into revenues from that CapEx spend. So I think right now, whereas in 2023, 2024, any company that was investing in AI was, receiving a very high trading multiple. I think now we're seeing not necessarily reversal, but I think, when you're trading at a very high premium or a very high multiple, you're priced to perfection. So you better deliver perfection. And I think what we're seeing is if you're not, or if investors are questioning where all this CapEx is going, you're going to start seeing some weakness. So I think, 2026, I think investors are looking under the microscope. They are paying more attention to where this money is going and if that's actually going to translate into growth.
That's interesting. I'm not sure if you saw that Anthropic, the AI provider, says we're not going to be putting ads into the answers that we provide people. ChatGPT, Sam Altman is upset about that because it looks like ChatGPT would like to bombard us with ads.
Right. And this brings up another point. There are many different AI tools right now. At the end of the day, in 5 to 10 years from now, how many AI bots do we actually need? Yeah. I mean, I think we saw it 20 years ago. Did we actually need more than one search engine? Did we need Yahoo and did we need Google? No, probably one search engine is enough. And so similar to AI, how many do we need? Google's and AI and OpenAI and Anthropic? How many different AI tools do we actually need, or do we really need to consolidate under one? And if that's the case, then all this CapEx could be for nothing.
Oh, yeah, that's interesting. Yeah, I guess specialists will always have their special type of AI, but you and I maybe not. Yeah, that's
exactly.
Interesting. Yeah.
And so, like I say, AI is here to stay. I'm not questioning that. I think we see it's a powerful tool.
Sure.
But for us, for our investors, it's just not a risk we're willing to take because I do think it's still early on. We're seeing lots of capital going into this sector with with a lot of questionable results right now. And maybe eventually this will be a good sector to lead to. But right now, without any dividend growth, with high multiples, it's just too risky of a sector for us to go into right now.
That was Rebecca Talcher, portfolio manager at New Haven Asset Management, joining us with some perspective. Up next, shares of Oracle skyrocketed today after the D.A. Davidson upgraded the stock to a buy. We've got more details on that after the break. Welcome back. Our next guest has upgraded Oracle shares to a buy. The stock rising today more than 9% in response. And our guest attributes this rating change to his updated view on OpenAI. So let's welcome Gil Luria, head of technology research at D.A. Davidson. Good to have you join us. Thanks so much.
Thank you.
So I was going to ask, what's behind your decision to upgrade? It's partially maybe or fully because of OpenAI. Can you explain?
Yeah, that's the biggest reason. The market has decided that Google is the only winner in AI and that the whole complex of companies around OpenAI are just not going to win as much. You can tell that by the stock performance over the last 6 months, where Google has significantly outperformed NVIDIA, Microsoft, Oracle, and CoreWeave. And we argue that that's not necessarily the case. The race is still on, and OpenAI has room in that race. They've done a few good things. One good thing they did is really focus on the two most important parts of the business, having a great frontier model and then having a support for ChatGPT, including turning on ads there. That's a good decision to be focused. The other thing that's happened is because there's the perception that Google's running away with AI, Microsoft, Amazon, and NVIDIA now have a very strong incentive to invest in OpenAI. So it looks to be able to raise up to $100 billion of additional capital by the end of March. And then finally, OpenAI is looking to introduce the most advanced model over the next few days and weeks. And if that model actually becomes better than Google's most recent Gemini model by any benchmark or by some benchmarks, then the perception that OpenAI is out of the race will probably change between having the best model, having capital on hand, and that will serve their orbit, the OpenAI complex, which is primarily NVIDIA and Microsoft, but also Oracle, that has a lot riding on OpenAI being successful.
Okay, I do want to talk about that new model you just mentioned, but just first off, you also said, the race to AI very much not finished yet. Given the fact that Oracle and OpenAI have some funding obligations expanding well past 2026, to what extent is your upgrade based on short-term factors, do you think?
Well, it's short to medium term in the sense that if OpenAI raises $100 billion and they have nearly $40 billion on hand, that can fund them for at least a couple of years, if not more, as it helps them get the compute that helps them ramp revenue and then pay for future obligations. So that fundraise will really buy them a long runway. For Oracle, they just raised their own capital in order to build out the infrastructure. As long as they complete that debt and equity offering successfully, they'll be able to have at least a year of building out this infrastructure and set themselves up next year to revisit those decisions. So our call is a year out. And again, we think OpenAI has an even longer runway, assuming they are able to complete this fundraise successfully.
Why do you believe that OpenAI's model is as strong or stronger than its competitors? We're going back to that model that you were talking about in your first answer.
Well, just the most recent version that they published, the 5.3 model, it's the first model trained on NVIDIA's Blackwell chips, and it already appears to be competitive with Gemini. So that's only a small incremental improvement. If they can have a bigger incremental improvement, which is being reported now that it's on its way, I think that'll grab people's attention. Internally, we have my colleague Alex Platt benchmarks these models. He thinks that Google's lead is very small, if any, and that a new model from OpenAI, assuming it represents a bigger leap forward, should take the #1 spot.
Why do you think, though, that the market was so quick to suggest that Google's kind of DeepMind and Anthropic were gaining such a momentum over competitors, including OpenAI?
I think it's a pendulum, right? Because just 6 months ago, everybody thought Google was the biggest loser, and it was trading at 18 times earnings and was left for dead. And then Gemini worked out, and Google Cloud started to accelerate, and there was talk about selling TPUs externally. And the narrative just shifted all the way to the other extreme, which is Google is the only winner. We think reality, as is in many cases, is somewhere in the middle. It's not a loser. It's not the only winner. It's a winner based on the fact that it has a great lab. It has the chips. It has the cloud. And they can deliver on those things. It's just that the race is not nearly over.
I know we were talking about this today, OpenAI's decision to introduce ads on its platform. I know you say this is important for monetization, reducing cash burn, but could this maybe hurt OpenAI in the end when some competitors don't have ads?
Not if they do it well. Let's not forget, Google's already presenting us with ads on the way to Gemini. It's not in the chat, which is what Anthropic was trying to poke fun at OpenAI, the Super Bowl yesterday. It's around the chat. It's before the chat. It's after the chat. Those are the types of ads we're going to see. We're not going to see ads in our conversation with ChatGPT. And as long as ChatGPT and OpenAI keep it like that, where you're seeing in the free version ads on the way to the chat or after the chat, they're not going to hurt themselves because consumers have gotten accustomed to this with Google. Not just Google search, but also Gemini. You're seeing a lot of ads on the way to your chat with Gemini. Consumers are okay with that as long as the chat's not about the advertising process.
And just lastly, before I let you go, very quickly, do you not think that this is maybe the future anyways of AI platforms having ads on their platforms, like for many companies, even though Anthropic said that they wouldn't do that?
In the free version, I would expect this is a lot like streaming. There's going to be a paid version, a subscription version that's ad-free. And then if you want the free version, you'll have to see at least some ads. That's the normal balance that's been struck on the internet for many years. This is just another iteration of that.
Okay, that's all the time we have. Gil Luria, Head of Technology Research at D.A. Davidson. Really good to have you join us. Thanks so much.
Thank you.
And we're going to take a quick check at what's happening on Bay and Wall Street to end the day. We'll take a look here. The TSX Composite finished the day up by more than a percentage point, almost 2%. The S&P 500 also up by 0.4%, and the NASDAQ Composite up by 0.9%. And of course, we're watching the Dow Jones today, which also broke a record after finishing higher than it closed on Friday. And Know Your Options is back. Tune in Wednesday at 3 p.m. Eastern to have all of your options trading questions answered by Chris Tom of Moat Financial. You can send us your questions at knowyouroptions@bnnbloomberg.ca. That does it for today's program. Thanks so much for watching.